Hello everybody. In this time we are discussing about investment fund. An investment fund is a supply of capital belonging to numerous investors used to collectively purchase securities while each investor retains ownership and control of their own shares. An investment fund provides a broader selection of investment opportunities, greater management expertise, and lower investment fees than investor might be able to obtain on their own. Types of investment funds include mutual funds, exchange traded funds, money market funds, and hedge funds. And then the types of investment funds. These are many different classifications for investment fund. For example, some are closed end, meaning they have a fixed number of shares or capital, whilst others are open end, meaning they can grow into unlimited shares or capital. The number and types of investors that may be involved in a fund, which is most relevant to understanding its beneficial ownerships, are generally shaped by the following classification. Classification 1 is retail investment funds, which are available for any person to invest in. Many exchange traded funds, pension funds, and mutual funds referred to as undertakings, for collective investment in transferable securities, or the undertakings for collective investment in transferable securities. The second category is private investment funds, which are only available to specific categories of investors that may exist in a jurisdiction, such as advised investors, high net worth investors, certified or self certified sophisticated investors, and restricted investors. Hedge funds, private equity funds, venture capital funds, and family offices are examples of private investment funds. And then, how do investment funds work? When you invest in a fund, your cash is pooled with that of other investors and used to buy shares, bonds, or other assets. Each fund has a manager who is responsible for guiding the fund towards its stated goals. In practice, this means buying and selling investments and monitoring performance. When investors buy a unit in a fund, They are typically offered two investment options. Option 1, income units. Any income the funds investment earn, such as dividends, are paid to the investors, usually made twice per year. Option 2, accumulation units. Income is reinvested in the fund rather than paid out to the investor. This process increases the price of each unit in the fund. Accumulation units may be better suited to investors who want to grow their money over the long term. And then, how to choose an investment fund? Mutual funds are one of the most popular investment options available to wise investors, more experienced investors, and those with extensive investing experience. All that is required is a basic understanding of the basics and a desire to expand one's knowledge in order to make smart, informed decisions. While it is simple and easy to register a mutual fund account, considering that online platforms now allow even first-time investors to finish the registration procedures in just a few minutes and without using any paper. It is most important to pick the right one, so consider the below given points before investing. The first, performances. Performance comparisons should only be made between funds of the same kind. Otherwise, they are meaningless. Performance metrics are only useful when they are compared to other funds in the same category. You should have a decent sense of how much you will invest in that category by the time you get to the stage of comparing performance data of different funds. The second, about costs. While the factors listed above are the most crucial in evaluating a fund, there is one additional element that is becoming increasingly relevant, and that is costs. Funds are not run for free, and they are not all run at the same expense. The third, about risk. Almost all investing, at least those that yield any substantial profits, is hazardous. Generally speaking, the riskier a fund is, the greater its potential for large gains. The ultimate measure of risk is whether a fund can provide you with returns that are sufficient to compensate for the risk it is taking on. This is more difficult to quantify than returns. The value research and rating is based on a mix of performance and risk evaluation. When we say a fund has a 5 or 4-star rating, we are referring to how well it fit in comparison to similar funds given its risk profile. And then the fourth, management. Fund management is a personality driven and creative activity. Although this may not be true for some types of funds, such as short-term fixed income funds, and of course, index funds, equities investing is more of an art than a science. When you buy a fund because you like its track record, you're essentially purchasing the track record of the fund manager. What you want to make sure is that the fund manager who was in charge of the portion of the fund's track record that you're interested in is still in charge. And the fifth, portfolio. Our basic portfolio analysis determines if a fund, in this case an equity fund, invests mostly in large, medium, or small enterprises. It also considers whether a fund favors pricey but rapidly rising firms or low priced equities belonging to slower growing opportunities, and especially opportunities is that which company's business. It is also possible to determine if a fund chooses safer or riskier stocks. I think it is enough for this sessions. Thanks for watching. Don't forget give this channel with your like, comment, subscribe, and don't forget share. Thank you.